Money has rules, not written in your country's constitution, not taught in your school, but rules that have silently shaped wealth for over 300 years. These rules decide who climbs and who stays stuck, and most people have never even heard of them. Here's a question. Have you ever wondered why wealth always seems to move in the same direction? The rich stay rich, the poor struggle, middle-class families work harder, but fall behind. It's not luck. It's not conspiracy. It's law, invisible laws of money that have existed since the early 1700s. Before we start, take a second and drop a comment below. Tell me where you're watching from and what time it is right now. I want to see how far these money laws have reached across time zones, countries, and generations. Now, let's get into the first rule. It's known as Gresham's Law. In simple terms, it says bad money drives out good money. 3 centuries ago, when coins were made from gold and silver, rulers began mixing cheaper metals to stretch their supply. People noticed. They started hoarding the pure coins and spent only the fake ones. Over time, the real money vanished. The bad money stayed in circulation. That same law still applies today, only now the metals are gone, replaced by credit, debt, and trust. Think of it like this. When central banks flood the system with cheap money, when interest rates are low and debt is easy, that bad money, inflated, borrowed, and devalued, drives out good money. Savings, patience, and discipline. People stop saving and start speculating. They chase returns instead of stability. And who benefits? Those closest to the money printer, the banks, corporations, and funds that receive the first wave of new dollars. By the time it reaches you through higher prices, loans, or wages, its value has already been diluted. Gresham's Law is not just history. It's your paycheck losing power every year. Now, here's the next rule. It comes from an 18th century economist named Richard Cannon. His insight was simple but devastating. Money is never neutral. When new money enters an economy, it doesn't affect everyone equally. It flows unevenly, enriching some, eroding others. This is known today as the Cantillon Effect. Imagine water pouring into a field. The areas closest to the source get soaked first. Further out, it's dry. In today's world, that source is the financial system. When central banks print money or governments spend heavily, the first recipients, investors, corporations, asset holders gain wealth fast. Stock markets rise, property prices surge, executive bonuses grow, but for workers and savers, prices climb before wages catch up. You feel the effects of inflation long before you benefit from the stimulus. This isn't theory, it's data. After 2008, the Federal Reserve added trillions to its balance sheet, stocks tripled. The top 1 cents wealth surged, but median household income flat for years. Housing more expensive than ever. That's the Cantillon Effect in real time. A law written 3 centuries ago, now running through every stimulus, bailout, and bond purchase. And here's where it gets interesting. These old laws don't just explain the past, they predict the future. Every time governments attempt to fix the economy with cheap credit, they reinforce these patterns. Bad money drives out good. The first recipients grow richer. The last in line pay the bill. You might think these laws are unfair, and you'd be right. But they're not malicious, they're structural. The same way gravity pulls objects down, money flows in predictable ways. Once you understand those flows, you can stop fighting them and start positioning yourself differently. Let's pause here for a second. You've probably noticed something. Every crisis seems to reward the same people. Every recovery pushes asset prices higher. Every solution creates a bigger bubble. That's not a glitch. It's how the system was designed centuries ago when early economists studied the first global markets and realized money behaves like energy. It moves to where it's treated best. But there was another law older than both Gresham S. and Cantillon S., and at mass, the one that locks inequality in place. It's called Pareto's principle, often simplified as the 80-20 rule. In any system, 80% of results come from 20% of participants. Applied to wealth, it means 20% of people control 80% of resources, and when left unchecked, that imbalance grows 10%, 5%, even 1%. You see it everywhere. In 1896, Italian economist Vilfredo Pareto noticed that 80% of Italy's land was owned by 20% of its citizens. Today, the same pattern appears in global wealth, corporate profits, and even attention. A small minority dominates most of the outcomes. The law has held for centuries because it is not about policy. It is about behavior. In markets, those who understand money multiply it. Those who don't lose it slowly through inflation, taxes, and bad timing. The system doesn't reward effort. It rewards understanding. And most people never study the rules. Let's connect the dots. Gresham's law explains why currencies decay. Cantillon's law explains why new money favors the top. Pareto's law explains why inequality expands. Together, they form the invisible foundation of modern finance, a structure so old and effective that even revolutions, wars, and crises haven't erased it. And yet, here's the paradox. The same laws that widen the gap can also help you escape it. Once you know how they work, you can move differently. You can hold assets that resist devaluation. You can position yourself closer to the source of new money through investments, businesses, or ownership, instead of being the last recipient in line. Before we move to the next section, think about this. Every financial crisis you've seen in your lifetime from 2008 to 2020 is a replay of these ancient laws. Money expands, quality declines, early receivers gain, late ones lose, the ratio shift, but the rhythm stays. In the next section, we'll explore how these 300-year-old rules evolved into modern policy and why even central banks can dictate escape them. Because once you understand how laws of money turn into laws of power, you'll see wealth differently. By the 19th century, these laws of money began shaping nations. Industrial revolutions, trade networks, colonial systems, all of them operated under the same quiet mathematics. Those who controlled the money supply controlled outcomes. Those who received new money first built empires. Those who received it last paid for them. Central banking turned these ancient ideas into official policy. Britain was the first to systematize the process. The Bank of England, founded in 1694, began issuing paper notes backed by gold. It lent to the crown, collected interest, and expanded the money supply through loans. Gresham's law began working instantly. Every time paper replaced metal, real value left the system. But the crown and financiers gained leverage. They could fund wars and colonies without waiting for tax revenue. That model spread. France followed, then the Netherlands, then the United States. By the 20th century, the Cantillon Effect was not a side effect. It was strategy. Central banks managed demand, stimulated economies, and funded governments with credit. Those closest to the issuance, banks, funds, corporations, grew larger. Savers and wage earners absorbed inflation. This structure now defines global finance. Every bond issue, every bailout, every quantitative easing program is the same act repeated. The first receivers thrive, the rest adapt. Gresham's law operates when excess credit pushes out productive capital. Pareto's law ensures concentration. You see it when asset bubbles form, when housing becomes unaffordable, when young people struggle to build wealth. These aren't isolated problems. They're results of laws that never change. To see how they work together, look at 1971. That year, the United States left the gold standard. Money became pure credit. From that moment, debt and dollars became the same. The supply of both expanded together. Gresham's law predicted what came next. When quality money disappeared, the system filled with quantity. Inflation rose. Savings lost power. Investment turned speculative. The Cantillon Effect made the gap visible. Those near the source, banks, asset managers, corporations, multiplied wealth through leverage. Ordinary people saw prices climb faster than income. Pareto's ratio hardened. The top gained share while the base lost. You live in that structure today. Every policy response since 1971 follows the same pattern. In 2008, credit markets froze. Central banks printed trillions. Asset prices recovered. Workers waited years for wage growth. In 2020, stimulus checks arrived after markets were already rising. By the time households spent the money, inflation had already reduced its value. Understanding these patterns is not cynicism, it's clarity. When you see a headline about interest rates, deficits, or quantitative easing, you're seeing ancient laws in motion. The names change, the math does not. So, how do you use this knowledge? You start by thinking like the early receivers. Money is a current. It moves fastest near the source. You need assets that float in that current. Businesses, equities, productive property. Wages alone fall behind because they adjust after prices rise. The system rewards ownership, not labor. This is why the wealth gap widens even in good times. Each round of expansion pushes more credit into financial assets. The owners of those assets benefit twice. First, through rising prices. Second, through access to cheap borrowing. Workers receive the spillover later as inflation and debt. Let's look at an example. Suppose the Federal Reserve cuts rates and launches asset purchases. Corporations borrow cheaply to buy back shares. Investors see prices rise. Executives collect bonuses. Now think about a household. Their savings earn less interest. Housing costs rise. To keep up, they take loans. That is the Cantillon Effect in action. Not theory, but policy outcomes measured in millions of lives. You can track the effect through data. Between 1989 and 2023, the top 1% share of U.S. wealth rose from 23% to over 32%. The bottom 50% gained little. Each recession accelerated the shift. The law is held constant. Pareto's pattern shows in markets too. A handful of companies drive most index returns. A few funds control most assets. A small number of investors dominate volume. In every category, concentration increases because feedback loops favor scale. Once a group gains early access to capital, it reinforces itself through compounding returns. These dynamics are not limited to the United States. Look at Japan. Decades of low interest rates and asset purchases enriched corporations and long-term holders. Look at Europe. Monetary unions transferred wealth toward core economies. Look at emerging markets. Dollar strength moves capital flows often against local interests. The rules operate globally because they are mathematical, not national. Now consider what happens when trust declines. Gresham's law warns that when people suspect a valuation, they hoard quality. Today, quality means scarce assets, land, commodities, productive equity, sometimes digital stores of value. Every rush into alternatives is the same behavior ancient merchants showed when coins were debased. They withdraw from bad money and hold what cannot be printed. For policymakers, this creates a trap. To support growth, they need expansion. But each expansion lowers quality, triggering flight to safety. To restore faith, they must contract. But contraction slows growth. The cycle tightens until confidence becomes the only anchor. That is where modern finance stands, sustained by faith in laws written centuries ago. Your response to these laws determines your outcome. If you rely on wages and savings, you are the last receiver. You feel inflation first and growth last. If you own productive assets, you are closer to the source. You capture the early flow. That difference compounds over decades. It defines class mobility. This knowledge also explains political tension. When the majority sense that growth benefits others first, they resist the system. When trust erodes, populism rises. When policies favor asset holders, debt expands to appease everyone else. Each response layers new credit over old, reinforcing the cycle. The outcome is predictable. Currency value erodes slowly. Debt ratios climb. Markets depend on stimulus. And yet the structure endures because no one can afford to stop it. Each actor behaves rationally inside it. Governments borrow because voters demand spending. Banks lend because rates are low. Investors chase yield because cash loses value. Workers borrow to live because wages lag. Everyone acts logically. The system still decays. You are not powerless inside it. But you must stop thinking linearly. These are not events. They are functions. Once you see them as laws, you can plan within their limits. The final section will show what comes next, how these same 300-year-old principles could shape digital currencies, de-dollarization, and future wealth distribution. The world now runs on code, not coins, but the same money laws decide outcomes. You can change platforms. You cannot change gravity. Gresham's law, the Cantillon Effect, and Pareto's law still describe how value moves, who gains first, and how wealth concentrates over time. Start with digital money. Central banks are building CBDCs. They say it is modernization. In practice, it extends control. When money becomes programmable, issuance and access can be targeted. Early receivers will still get first exposure. In emergencies, stimulus can go direct, but the logic does not change. Those closest to the origin of new currency remain ahead. Those furthest adjust later. Private tokens follow the same pattern. Each boom begins with early insiders holding large allocations. As adoption spreads, new entrants pay higher prices. When liquidity expands, value shifts upward. Gresham's law appears again. When poor projects flood the market, good tokens vanish into wallets, bad ones circulate, quality exits circulation because trust breaks. De-dollarization debates show another law at work. Nations holding dollar reserves know the pattern. The issuer benefits first. Every new dollar entering global trade strengthens U.S. access to goods and credit. Foreign holders get later claims. Over time, that imbalance drives diversification. They seek gold, commodities, or alternative currencies. The law repeats. Bad money chases out good until credibility resets. Inflation is no longer a local issue. It is a global function of credit growth. From 2000 to 2023, total worldwide debt quadrupled. Every stimulus, every deficit, every rescue added to the pile, debt became the asset. Without it, no market clears. Central banks now hold trillions in sovereign bonds. That makes them both buyer and regulator. They stabilize markets by owning them. This is the purest form of the Cantillon Effect. The state issues debt. The central bank buys it. Commercial banks use it as collateral. Asset prices rise. Wages trail. It looks modern. It is ancient. What comes next depends on how long confidence holds. The system cannot unwind debt without breaking collateral values. It cannot expand indefinitely without eroding purchasing power. The only path left is management, extending maturity, lowering real yields, shifting perception. When trust weakens, investors move to scarcity. Gold demand rises. Real estate surges. Equities linked to tangible output outperform. Digital assets attract attention because they cap supply. Each movement is rational under Gresham's principle. People always trade away what loses value for what retains it. If you want to navigate the next cycle, study proximity. You cannot stop credit creation, but you can move closer to it. Own assets that benefit from early liquidity. Avoid those priced only by hope. Diversify across forms of money. Track policy shifts, not promises. History shows these transitions repeat. In the 17th century, debased silver wrecked Spain's empire. In the 18th, Britain's paper experiments funded its navy. In the 20th, fiat money financed wars and welfare. In the 21st, digital credit finances everything. The surface changes. The core mechanism endures. You live in a system where value is assigned, not discovered. When new money enters, it rewrites prices. It rewards debtors over savers, owners over earners. You cannot wish that away. You can only position yourself inside it. Look ahead 20 years. If inflation averages 2%, half of today's savings will lose value. If asset inflation outpaces wages, ownership gaps will widen. Pareto's ratio will hold. A minority will control the majority. That is not conspiracy. It is arithmetic. Governments will respond with redistribution, taxes on wealth, digital tracking, universal credits. Each fix adds complexity. Each policy needs funding. More funding means more debt. The circle continues, but awareness matters. When you understand the laws, you stop chasing noise. You see stimulus as timing, not salvation. You measure policy by flow, not intent. You build habits that align with structure. Investing early, holding scarce assets, minimizing liabilities. This is the lesson buried in 3 centuries of finance. Prosperity follows knowledge of cause and effect. Gresham warned about quality. Kahn mapped sequence. Pareto described concentration. Together they explain why some climb while others tread water. Money is information. Power comes from reading it correctly. Most people study careers, not systems. They trade time for currency without asking who issues it, when, and at what cost. Once you start asking, patterns appear. You stop reacting. You start planning. The world is entering another monetary experiment. Rates rise. Debt grows. Trust shakes. The same laws will decide outcomes again. Those who learn them early will adjust first. Those who ignore them will notice too late. You're not excluded from the story. You are already in it. Every payment, every loan, every investment feeds the mechanism. The question is whether you understand your position inside it. So as you leave this video, think about proximity. Where do you stand in the flow? How do you move closer to the source? Which assets hold value when quality drains from the system? These are the questions that separate observers from participants. Thank you for watching. If you learned something new, share where you're tuning in from and what time you're watching. Your perspective adds to the map. Stay alert. Stay informed. The laws of money never change. Only the players do.